Options trading. You've probably heard the term thrown around, and maybe your brain immediately just flashes to these super complex charts and a whole bunch of jargon that makes no sense. But what if I told you it's actually way simpler than it looks? Well, in the next few minutes, we're going to pull back the curtain and demystify it completely, turning all that confusion into real, practical clarity.
So, which is it? Is it just a confusing mess designed to make your head spin, or is it an incredibly powerful financial tool? That's what we're here to find out. And I promise, by the end of this, you'll see it's absolutely a tool you can get your head around. We're going to turn that big question mark you see into a genuine light bulb moment for you.
So here's our game plan. We're going to start with the absolute basics. What even is an option? Then we'll look at the 4 fundamental trades that make up, well, pretty much everything. From there, we'll dive into the world of buying and selling, and we'll wrap it all up with the most important part, why any of this actually matters to an investor. Let's get into it.
All right, first things first. What is an option? Seriously, if you can nail this one core concept, everything else just clicks into place. This is the key that unlocks the entire thing.
Okay, let's just ignore the textbook definition for a second. At its heart, an option is just a contract. That's it. It's an agreement between 2 people. And this agreement gives one person the right to do something and the other person the obligation to do something. And it all revolves around a stock, a price, and a date. Forget the fancy words, it's just a deal. And every single one of these contracts is built from 3 simple parts. You've got the strike price, that's the agreed upon price for the stock. You've got the expiration date, the deadline when the contract is no good anymore. And finally, the premium. That's just the fee, the cost of the contract itself. Price, date, cost. That's really all there is to it. Now, this is incredibly important, so you gotta remember this. One options contract always, and I mean always, controls 100 shares of stock. So if you see a premium on your screen that says, I don't know, $2.50, you are not paying $2.50. Nope, you're paying 100 times that, which is $250. That multiplier effect is a huge part of where the power and the risk of options comes from. Okay, now that we've got that foundation built, we can actually map out the 4 basic trades. And the great news is we can fit this entire world into a really simple framework that makes it all super easy to remember.
So every single trade has 2 sides, right? First, you have the buyer. The buyer pays the premium, and for that money, they get a right to act, but never being forced to. They have the flexibility. On the other side, you've got the seller. They're the ones who collect that premium, but in exchange, they take on an obligation. They have to follow through if the buyer decides to use their right. So one side has a choice, the other has a responsibility. Getting that difference is absolutely crucial.
The other half of our simple little framework is even easier. It's just calls versus puts. And it boils down to this. If you think a stock's price is going to go up, you're dealing with a call. If you think the stock's price is going to go down, you're looking at a put. Calls up, puts down. It's really that simple.
So let's step into the buyer's shoes for a minute. When you buy an option, you're not just buying a contract, you're buying power. You're buying the flexibility and the choice to make a move, but you're never, ever locked in or forced to do anything you don't want to. Let's make this really, really simple with an analogy. Imagine you see a used car for sale for 10 grand. You really want it, and you have a hunch the price is about to go way up. So you go to the seller and say, hey, I'll give you $100 right now if you promise to sell me this car for 10 grand anytime in the next month. Boom. That $100 just bought you the right, but not the obligation, to buy that car at a locked-in price. You just bought a call option.
Okay, now let's apply that exact same logic to a stock. Look at the table here. The stock is trading at $100. You buy a call option with a strike price of $100. The cost, that premium, is $2 a share. And remember, that's really $200 out of your pocket. Now let's say you were right and the stock shoots up to $105. Because of your contract, you get the amazing right to buy it at your locked-in price of $100. That's a $5 profit per share right there. But you have to subtract the $2 premium you paid, right? So your net profit is $3 per share. And since your contract controls 100 shares, that's a $300 profit on a $200 investment. Not bad.
Okay, what about the other side, buying puts? Well, the best analogy for a put is just plain old insurance. You own a $500,000 house and you pay a company a premium for an insurance policy. Why? To protect you in case its value drops, right? Buying a put option is exactly like buying an insurance policy on your stock. Let's see how that plays out with a stock. Let's say a stock is at $50. You're worried it's going to drop, so you buy a put with a $50 strike price. You pay a $5 premium for it, so that's a $500 total cost. And guess what? You were right. The stock tanks and falls all the way to $40. But your contract gives you the right to sell it at that much higher price of $50, so you're making a $10 gross profit per share. Subtract the $5 premium you paid, and your net profit is $5 a share. For your 100 shares, that's a total profit of $500. You literally made money because the stock went down.
All right, let's flip the script entirely. It's time to step into the seller's shoes. When you sell an option, you're the one on the receiving end of that premium. But here's the catch. In exchange for that instant cash, you are taking on an obligation.
You see, the seller is playing a totally different game. What's their perfect scenario? It's simple. They want to collect that premium you paid them, and then they want absolutely nothing to happen. They are hoping and praying that contract just expires worthless so they can pocket the cash free and clear.
So here's a classic strategy for sellers. Let's say you already own 100 shares of a stock that's at $100. To make a little extra income, you decide to sell a call with a 105 strike price. Someone buys it, and you immediately get a $200 premium in your account. Now there's a fork in the road. If the stock stays below $105, that option expires worthless. You keep the $200 and you keep your shares. It's a win-win. But if the stock soars past $105, you're now obligated to sell your shares for $105 each, even if they're trading at $110 or $120. You still made a profit, sure, but you capped your own gains.
Selling a put works in a very similar way, just in reverse. A stock's at $50, and you think to yourself, I wouldn't mind owning the stock if it dropped to $45. So you sell a put with a $45 strike, and you immediately collect a $500 premium. If the stock stays above $45, fantastic. The option expires, you just made $500 for doing nothing. But if the stock takes a nosedive below $45, you're now on the hook. You are obligated to buy 100 shares at $45, even if the real market price is now down at, say, $40.
Okay, so we got the mechanics down, the calls, the puts, the buying, the selling, but the really big question is, so what? Why would anybody go through all this trouble? Well, in our final section, we're going to see how investors use these pieces to build a really powerful strategic toolkit.
You really should think of options as a financial multi-tool. You need to control a big position with just a small amount of cash? That's leverage. You want to generate a steady stream of cash flow from the stocks you already own? You can sell options for income. You worried about a potential market crash? Well, you can use puts as hedging, which is basically portfolio insurance. From pure speculation on price movements to locking in future prices, it's just an incredibly versatile set of tools for almost any goal you can imagine.
So there you have it. At the end of the day, options offer this incredible combination of both immense power and very significant risk. We started out with a question, confusing complexity or powerful tool? And hopefully it's crystal clear now that they are an amazing tool. The real question isn't just what you learned today, but how you'll decide to use that knowledge and balance that power with responsibility on your own financial journey. What's your next step?